The best thing that ever happened to me as an investor was going broke. I know that sounds backwards. Most people think winning in markets starts with finding the biggest return and holding on tight. My life taught me the opposite. I began to win when I stopped chasing what looked exciting and started building for what could survive. If you want to hear how money really works from the scars, not the slogans, stay close to me here, because the lesson most people miss is the one that keeps them alive when the cycle turns. I did not build my edge by being the loudest man in the room. I built it by learning how quickly confidence can become ruin. That is not a lesson you get from a chart going up. That is a lesson you get when your own mistakes hit your own life. When I was young, I loved markets for the same reason a lot of young people do. They looked like a puzzle, and I wanted to solve it. I started buying stocks as a kid after hearing people talk about them around a golf course where I caddied. I saw one cheap stock triple, and I thought I had found a magic door. That early win felt good, but it also planted a dangerous idea in me. It made me think the game was about finding what could go up the most. For a while, that way of thinking seemed to work. I studied hard. I watched how economies moved. I learned about debt, interest rates, inflation, and how governments react when things get ugly. Inflation is when prices rise and your money buys less. Interest rates are the cost of borrowing money. These things sound dry from far away, but in markets, they change everything. They change what people fear, what companies can handle, and what assets can keep standing when pressure shows up. One of the first great shocks of my life came in 1971. I was a young clerk on the floor of the New York Stock Exchange when the United States broke its link to gold. Most people did not call it a default, but that is what it was in spirit. A default means a promise is changed because the old promise can no longer be kept. I expected the market to hate it. Instead, stocks rose. That moment stayed with me because it showed me something simple and huge. Markets do not move on news alone. They move on the gap between what people expect and what reality becomes. That idea shaped the rest of my life. I stopped looking at headlines as answers and started looking at them as clues. I wanted to understand the machine underneath. I wanted to know why one shock crushed prices while another shock pushed them higher. So when I founded Bridgewater in 1975 out of my 2-bedroom apartment, I was not trying to build a place that guessed better than everyone else on television. I was trying to build a place that understood cause and effect better than the crowd. At first, I still had a young man's weakness. I loved being right. I loved seeing a pattern before other people saw it, and when my calls worked, that feeling got stronger. Success is often more dangerous than failure when it comes early. Failure can humble you. Early success can make you think your instincts are cleaner than they are. I did not know it then, but I was heading toward the most valuable beating of my career. In 1982, after Mexico's debt problems and a pile of stress in the global system, I became convinced the world was heading into a depression. A depression is not just a recession. A recession is a hard slowdown. A depression is a much deeper collapse that can break banks, jobs, and confidence for years. I made that call publicly, and I traded for it. I thought I understood what was coming. I was dead wrong. The economy did not fall into a depression. The market began one of the great bull runs in history. That mistake did not stay inside a spreadsheet. It came straight into my life. I lost so much money that I had to let people go. I had built something with care, and I watched it almost come apart because I confused conviction with truth. I even had to borrow $4,000 from my father to get by until we could sell our second car. $4,000 is not a big number by hedge fund standards, but when you need it to keep breathing, it feels like a mountain. That was the moment when the game changed for me. What broke me was not just the loss. It was the shock of being so sure and so wrong at the same time. That pain forced a question into my head that never left. Not, how can I prove I'm right? But how do I know I'm right? That sounds like a small change. It is not. That one shift can separate a gambler from an investor. If a thought like that matters to you, keep coming back, because your results often change the moment your questions do. After that, I started building my thinking around humility. I do not mean weakness, I mean respect for how hard reality is. I started seeking out independent thinkers who disagreed with me. I wanted my ideas stress tested. Stress tested means putting an idea under pressure to see where it breaks. I learned that if an idea cannot survive honest disagreement, it has no business holding real money. That became part of my culture, part of my process, and part of how I slowly rebuilt everything I had nearly destroyed. Most people still think the best investor is the one who predicts the future most often. I do not. I think the best investor is the one who can survive being wrong, because everyone is wrong sometimes. That sounds less glamorous, and that is why the public usually misses it. The public falls in love with hot streaks. It loves the person who made one giant bet and looked like a genius. But markets are full of people who looked brilliant for 3 years and disappeared in the fourth. I did not want to be one of them. The deeper lesson was this: return without risk control is often just delayed pain. A big gain can make you feel smart, but if the path to that gain can also wipe you out, then the gain was never as good as it looked. I started to care less about how high a portfolio could fly in a perfect year and more about how it behaved in bad weather. That shift sounds boring to some people. To me, it became freedom. I no longer needed to be a hero every quarter. I needed to stay sound. That is where a lot of people misunderstand my work. They think I stopped caring about returns. I did not. I stopped worshiping them. I began separating return into pieces. One part comes from cash, one part comes from beta, which is just the return you get from being exposed to markets. And one part comes from alpha, which is skill. That matters because many people think they are brilliant when they are simply riding a wave. When the wave turns, their skill disappears. Once I saw that clearly, I began thinking in a different order. Instead of asking, what asset will do best, I asked, what environment am I really betting on? That is a very different question. If I load up on stocks, I'm usually betting that growth will be better than expected and inflation will not cause trouble. If I load up on long bonds, I am usually betting that growth will weaken or inflation will fall. A portfolio is never neutral. Even when people think they are diversified, they are often making one hidden bet. That hidden bet is all over the classic 60-40 portfolio. 60% in stocks and 40% in bonds sounds balanced. By dollars, it looks balanced. By risk, it often is not. Stocks move much more than bonds, so that 60% stock slice can drive almost all of the pain and almost all of the drama. That means many people who think they are diversified are really just heavily exposed to one economic outcome with a smaller bond cushion on the side. That is not balance, that is appearance. So I kept pushing toward a question that became central to my life. What would a portfolio look like if it did not need me to predict the future correctly? That question led to one of the most important things I ever built. In 1996, I created all weather for my trust assets. I wanted something that could hold up across changing conditions long after I was gone. That goal mattered. I was no longer designing for applause. I was designing for durability. There is a world of difference between those two motives. The idea behind it was simple enough to sketch on a napkin. Economies tend to surprise in 4 basic ways. Growth can rise, growth can fall, inflation can rise, inflation can fall. Different assets do well in different environments. Stocks like stronger growth, bonds usually like weaker growth and lower inflation. Gold and commodities often help when inflation rises. So instead of making one big bet, I wanted a structure where each major environment had something working for me. That sounds obvious after you hear it, but living it is hard. People do not get rewarded for being balanced in the middle of a boom. They get rewarded for leaning hardest into whatever is already working. The crowd always wants more of what just went up. That is true for meme stocks, for houses, for tech bubbles, for credit booms, for everything. Credit is borrowed money. When credit expands, it can make everything look healthier than it really is for a while. Then the bill arrives. I have watched that movie over and over. I watched it in inflation shocks. I watched it in debt bubbles. I watched it in the years before 2008 when too many people believed housing prices could keep rising and leverage could stay harmless. Leverage means using borrowed money or borrowed exposure to make your gains bigger. It can also make your losses much bigger. Used recklessly, it is dangerous. Used carefully on safer assets, it can help balance a portfolio. The tool itself is not the sin, the misuse is. If you are still with me, ask yourself something simple. If your portfolio only works when growth stays strong, rates stay friendly, and inflation behaves, is that really a plan, or is it just a wish dressed up as a plan? That is not a trick question. Most people do not ask it because the honest answer makes them uncomfortable. But discomfort, if you face it early, is much cheaper than panic later. A lot of people think protecting yourself means giving up too much upside. In a hot market, that can look true for a while. The careful investor can seem slow. The balanced investor can seem cautious. The person who keeps dry powder can seem timid. Dry powder means cash or easy reserves you can use later. But I learned long ago that what looks slow in a boom can be exactly what lets you move clearly in a bust. The market has a way of punishing emotional speed. Look at what happened in 2008. The S&P 500 fell about 38.5% that year. A fall like that is not just a bad number on a screen. A loss that deep can change retirements, careers, marriages, and how people sleep. Many hedge funds were crushed right along with the public. My flagship Pure Alpha fund gained about 9.5%. I do not say that to boast. I say it because it shows what happens when survival is built into the structure instead of added as an afterthought. And the point was not that I called every turn perfectly. The point was that I had spent years trying to understand how different forces interact and how to avoid being dependent on one story. When everyone is leaning one way, they are often fragile in the same place. That is where true diversification matters. Diversification means not putting all your risk in one kind of outcome. The public hears that and thinks it means owning many things. I learned that owning many things is useless if they all fail for the same reason. I also learned that avoiding a deep hole is more powerful than people think. If you lose 50%, you do not need 50% to get back. You need 100%. That is the arithmetic of pain. It is not emotional, it is mathematical. Once that sinks into your bones, you stop treating risk control like a side note. You start seeing it as the heart of compounding. Compounding is what happens when gains build on gains over time. It works beautifully, but only if you stay alive long enough for it to do its work. This is one reason I stopped admiring investors who look brilliant only in one climate. Anybody can look smart when one force dominates the world for a decade. If inflation keeps falling for years, one set of assets looks magical. If money is cheap for a long time, another set looks untouchable. But those are seasons, not permanent truths. Real investing is not about marrying one season. It is about respecting that climates change and markets reprice fast when they do. If that makes you rethink how you judge winners, stay with me. A lot of what gets celebrated in finance is just a person being in harmony with the cycle they happen to be born into. The cycle gets the applause and the investor gets the credit. Then the cycle changes and the legend suddenly looks confused. I never wanted my fate tied to one kind of weather. I wanted a framework that could breathe through many of them. There is another layer here, and it is bigger than portfolios. Since the early 1970s, we have lived in a world where money is no longer tied to gold in the old way. That changed the whole system. It gave governments and central banks much more freedom to create money and credit. That flexibility can help in a crisis, but it also invites excess. Excess debt builds quietly. Then one day it is no longer quiet. Then rates, inflation, and policy begin to fight each other. And investors who only learned one kind of world get blindsided. That is why I spent so much time studying debt cycles. A debt cycle is the long rise and strain of borrowing over time. When debt grows faster than income for too long, the system gets tight. Payments eat up spending. Policymakers then face bad choices. They can cut rates, print money, restructure debts, or shift pain around the system. None of those choices are clean, and each one helps some assets while hurting others. That is exactly why a one-way portfolio is far riskier than it looks. History made this lesson plain long before my career. In the 1970s, inflation hurt both stocks and bonds in ways many investors were not prepared for. People who thought bonds were always a safe partner learned that safety depends on the problem in front of you. In the 1930s, debt and deflation crushed confidence in a different way. Deflation means prices fall and money becomes harder to get. Different decade, different enemy, same basic lesson. If you assume tomorrow will look like the recent past, the market eventually teaches you humility. The public usually sees these events as separate stories. I do not. I see repeating patterns. I see debt building, confidence building with it, and then some limit appearing. I see policymakers react. I see investors discover that what felt safe was really a narrow bet. I see the same emotions with new names: greed, fear, relief, denial. Then I see the same mistake return because every generation thinks its tools are newer than human nature. That is also why institutions eventually paid attention to ideas like risk parity. Risk parity means balancing risk more evenly instead of just balancing dollars. Large pensions and big pools of capital do not have the luxury of gambling on one good decade. They have obligations that keep coming. Retirees still need checks. Endowments still need to fund schools. Institutions learn, sometimes painfully, that a portfolio that looks normal can still be dangerously concentrated under the surface. Surface balance is cheap. Real balance takes thought. Now, I know the fair objection. People hear about risk parity or all weather and say, fine, but won't that lag in a raging bull market? Sometimes, yes, it can. If stocks are ripping higher and inflation is calm and rates are falling, the concentrated stock investor may look smarter for a long time. I accept that. I never built my framework to win every beauty contest. I built it to keep standing through environments that make beauty contests look silly. That trade is easy for me. It is hard for people addicted to comparison. There is a second objection, and it is also fair. People hear the word leverage and think danger. Sometimes they should. Borrowed exposure in the wrong hands is dynamite. But here is what many miss. Risk does not come from one word. It comes from how the whole structure behaves. A portfolio with no borrowed exposure can still be wildly risky if it depends on one fragile outcome. A carefully balanced portfolio can use some leverage on lower volatility assets and still be sturdier than a plain portfolio that is really just a stock bet. That is the difference between looking safe and being safe. Markets punish that confusion all the time. People think cash flow from one booming sector will protect them until that sector cracks. They think home prices in one city tell them something permanent. They think long periods of calm mean danger is gone. Calm often hides leverage. Calm often hides crowding. Calm often hides bad assumptions that nobody bothers to examine because the price chart is still going up. So I train myself to keep asking a different kind of question. Not, what is everyone excited about, but what is everyone assuming? That question goes deeper. Excitement is visible. Assumptions are buried. Yet buried assumptions are what break portfolios. When those assumptions crack, the move is fast because everyone runs for the same door. If you want to be sharper with your own money, that is one of the best habits I can pass on to you. Learn to study assumptions, not just prices. And think about your own life for a moment. Would you rather own something that looks brilliant only when conditions stay easy, or something that can keep working when rates jump, inflation bites, growth slows, or policymakers panic? That is not just an investor's question, it is a life question. A good plan is not the one that flatters your optimism. It is the one that respects reality when optimism stops being enough. By the time Bridgewater grew into one of the largest hedge funds in the world, my old hunger had changed shape. I still wanted performance. I still wanted excellence. But I no longer measured excellence by how much risk I could pile up when the wind was at my back. I measured it by how well my process could handle being tested. I cared about having people around me who could challenge me. I cared about making decisions in a way that could survive my own blind spots. That is another reason the title of great investor can be misleading. People imagine a person with a crystal ball. I never trusted crystal balls. I trusted systems, feedback, disagreement, and adaptation. I trusted studying history because history shows what happens when debt grows too large, when money gets printed too fast, when empires stretch too far, and when investors confuse a long run with a permanent law. The names change. The mechanics do not. I built my career on that belief, and I think that matters even more now. Today, the world carries huge debt loads. Governments run large deficits. Central banks face a hard balancing act between inflation and growth. Geopolitical tension is higher than many people want to admit. Reserve currencies do not keep their status forever by magic. A reserve currency is the money the world trusts most for trade and savings. That status is powerful, but it can weaken over time if debt, politics, and trust begin to pull apart. These are not reasons to panic. They are reasons to think structurally. From here, I can imagine several paths. In one path, inflation keeps cooling, growth slows but does not break, and risk assets do fine for a while longer. In another, inflation proves sticky. Rates stay higher than the crowd wants, and the old playbook struggles. In a third, growth rolls over hard. Policymakers cut, and different defensive assets take the lead. In a fourth, some political or geopolitical shock changes trust faster than expected. I do not need to know exactly which path arrives next to know the right question. I need to know how exposed I am to each one. That is the mindset shift that changed my life. I stopped asking the market to reward my certainty. I started building around my uncertainty. Once I did that, my decisions got cleaner. I no longer needed to act smart for the crowd. I needed to be honest with myself. I needed to admit that the future branches, I needed to build in a way that could live through those branches. That is what people often miss when they look at my record from the outside. They see performance. I see architecture. If you take only one practical lesson from me, let it be this. Before you ask how much you can make, ask what can hurt you badly. Write it down. Name the environment your portfolio secretly depends on. Name what happens if inflation surprises higher. Name what happens if growth falls. Name what happens if both stocks and bonds disappoint at the same time. If you cannot answer those questions simply, you do not yet understand your risk. And if you do not understand your risk, then your return is partly luck. I would also tell you to respect drawdowns more than stories. A drawdown is just a decline from a high point, but in real life, it is much more than that. It is the thing that forces bad decisions. It is what makes people sell near the bottom, borrow at the wrong time, or abandon a sound plan because they never prepared emotionally for pain. A portfolio that lets you stay calm is worth more than a portfolio that looks heroic right before it breaks you. Calm is underrated in finance. It should not be. And I would tell you to seek disagreement before the market forces it on you. Find people who think differently and can explain why. Not trolls, not noise, real thinkers. The market will always give you feedback eventually, but market feedback is expensive. Honest disagreement is cheaper. That lesson helped rebuild my life after 1982. It can also protect you from the most common trap in money, which is mistaking your own belief for proof. When people say I stopped chasing returns and won anyway, that is close, but it is not the full story. I did not become passive. I became deeper. I stopped confusing excitement with edge. I stopped chasing what looked best in the current light and started asking what would still make sense when the light changed. I learned that the investor who survives many worlds usually beats the investor who dominates only one. In markets, endurance has a return of its own. So when you look at my story, do not focus on the size of the fund or the fame of the name. Focus on the pivot. Focus on the moment when arrogance ran into reality and reality won. That was the beginning of everything good that came after. The markets did not reward me because I became fearless. They rewarded me because I finally learned what fear is for. It is there to remind you that the future does not owe you agreement. I built my life around one simple truth. The goal is not to make a portfolio that feels brilliant in sunshine. The goal is to make one that can still walk when the sky turns. Once I understood that, I stopped trying to impress the future. I started preparing for it, and that is when I began to win in a way that could last. I stopped trying to be right about every next move, and that is when the next move lost the power to destroy me.